The London silver market didn't slow down this morning. It went dark. Phones rolled straight to voicemail. Quotes vanished. Withdrawals were pushed into queues. And according to one industrial buyer, a standing offer of $200 per ounce for immediate delivery couldn't attract a single seller willing to hit the bid. That is what happened. You're listening to the Daily Metals Briefing. Let's get into it. Because if London is the heart of the physical silver market, then what I watched on my screen today looked like cardiac arrest. It was 9:15 a.m. London time. Markets had been open long enough for the usual chaos to appear. The fix window, the scramble, spreads tightening, sudden bursts of volume as the largest players established the reference price miners, refiners, and manufacturers used to settle contracts. Except none of that showed up. Instead, I was staring at a chart that didn't feel calm. It felt controlled, flat, unnaturally still, the kind of stillness you get right before something breaks. So I started calling. First call, the general line tied to the body that oversees London's Bullion ecosystem. The place where a human being normally answers, redirects you, or at least points you somewhere useful, straight to voicemail. No receptionist, no transfer. No, please hold, just a dead-end recording like the building was empty. Second call, one of the largest precious metals desks operating in London, a firm that sits at the center of custody in metal flows for major vaulting networks. Voicemail. Third call, another major bullion desk. It rang, and rang, and rang. I counted the rings because the silence was getting loud. Over 40 rings. Then a generic mailbox message, and then the punchline, mailbox full during the busiest session after a holiday break. Next, I called a vault operations contact, someone who normally answers immediately because his job is literally to move metal when the city wakes up. Voicemail again, so I switched channels, email, WhatsApp, Signal. 3 different contacts, 3 different routes. Same result. No replies. No, we'll get back to you. No, markets are thin. No, try later. Just empty air. And this wasn't a weekend. It wasn't a bank holiday. This was Monday morning, December 29th, the first full trading day after Christmas. London should have been roaring. Instead, it felt like someone flipped a switch and killed the sound. Here's why that matters. London isn't just a market. London is an artery. A massive share of the world's wholesale physical silver trade is coordinated there. A large portion of the metal that underpins the global paper structure sits in its vault networks. This is where silver is sourced, swapped, leased, and moved to satisfy delivery obligations elsewhere. If London goes silent, the issue isn't sentiment. If London goes silent, the pipe is clogged. And when the pipe is clogged, the screen price turns into theater. You might be asking the obvious question. If the pipe is clogged, why isn't the price exploding higher? If this is real, why isn't silver already at $100? That's the right question. But it assumes this market is allowed to behave like a free market. It isn't. Not when the stakes get this high. What I saw today didn't look like panic. It looked like containment. A true uncontrolled failure is messy. Spikes, gaps, halts. Liquidity vanishing in bursts. Traders shouting dumping risk wherever they can. Today was the opposite. It looked like bids were removed on purpose and everyone was told to stop talking. That points to one thing, a stand down. Not a technical glitch, not low volume, not people being away. A stand down. The kind that happens when the people who manage the plumbing decide it's safer to freeze the flow than let price discover the truth. Think about it. If London violently reprices physical silver before New York even wakes up, you don't just get a price move. You get a narrative collapse. Industrial buyers start calling their boards. ETF holders start asking questions. Everyone tries to convert paper into metal at the same time, and that's the one thing the system cannot afford, a synchronized run. So what do you do when you can't print ounces? You delay the run. You slow conversions. You quiet the phones. You make the market look stable. You keep the pressure valve shut long enough to stage manage the US Open. That's exactly what today felt like. Then came the message that made it worse. Late morning London time, a contact tied to vault operations at a major storage facility sent a short note. No drama. No emphasis. Just an operational instruction effective immediately. Silver withdrawal requests were being queued pending compliance review. Staff were instructed to cite ongoing market disruption. And the key line, we've been told this is not temporary. Read that again, not temporary. That's not a delay, that's a lock. Now let's translate what that means for anyone who thinks they're protected because their metal is allocated. In this world, there are 2 buckets. Unallocated means you don't own bars. You own a claim, you're a creditor. If the institution fails, you stand in line. Most people understand that risk. Allocated is supposed to be different. Allocated means specific bars set aside. Serial numbers, a list, a legal structure that says this metal is yours, stored in a building you don't control. That's the promise. Here's the uncomfortable truth. If you own allocated bars and the gatekeeper refuses to release them, you don't have silver. You have paperwork. And paperwork is only as strong as the moment you're allowed to enforce it. If withdrawals can be frozen under a vague label like market disruption, your property rights have just been paused by policy. Not by a judge, not by a court, by management. That's what a lock looks like in a modern market. No soldiers, no chains. Just an email template sitting in a compliance queue. And if that lock is real, the implications are staggering. London's vault networks collectively represent a massive pool of silver that the paper ecosystem assumes is available. Available to settle, available to lease, available to swap, available to deliver. But if it can't leave the building, it isn't available. It exists as a number in a report, a line in a statement. A comfort blanket for anyone who believes supply is abundant until they actually ask for it and are told to wait. This is how a shortage shows up in 2025. Not with empty mines, with full vaults that won't open. Now the story shifts from financial intrigue to industrial emergency. Because the real economy doesn't care about charts. It cares about delivery windows. Factories don't keep 6 months of silver on hand. They run just in time. Days, not seasons. And when the steady flow stops, the clock starts immediately. Before recording this, I got a call from procurement at a major U.S. manufacturer tied to the solar supply chain. I can't name the company, but it's a top-tier operation. Real headcount, real contracts, real penalties for missed delivery. His voice wasn't excited, it was tight. He said their silver paste supplier had flagged an inability to fulfill a first quarter order. The reason wasn't price, it was sourcing. Force majeure language. Inability to secure metal from European channels. They have 11 days of inventory left. 11. If material doesn't arrive within that window, a major facility shuts down. Thousands of workers sent home. Utility contracts delayed. Penalties triggered. Projects stalled. So they did what rational industrial buyers do when an input becomes existential. They tried to buy it any price. He told me plainly that he was authorized to source silver at whatever it took for immediate delivery. He offered $200 an ounce and couldn't find a single seller. Let that sink in. While your screen may show a sleepy spot price, a $200 physical bid was rejected. That doesn't mean the true price is $200. It means the true price isn't being quoted, because quoting it would expose the shortage. And once the shortage is exposed, the paper structure has to answer questions it can't answer. So instead of letting price clear the market, the system hides the market. It turns the screen into a story. Real transactions happen quietly, in private. Silence becomes the signal. This is where people get confused. They ask, if it's so tight, why can't I see it on the chart? Because charts don't measure metal. They measure agreements. And when agreements are under stress, the first thing that breaks isn't price. It's the willingness to make offers. Liquidity dies before the headline changes. Now add the second domino. Switzerland. London trades in stores. Switzerland refines. It's the bottleneck between raw material and the formats industry actually needs. High purity bars, specific standards, specific sizes. Reports began circulating that Swiss refiners were implementing temporary export review protocols for refined silver. Call it review, call it compliance, call it controls. The effect is the same. Delay, friction, a throttle on outbound supply. If refining tightens while London vaults are effectively locked, you don't get a squeeze. You get a global traffic jam. Ore can exist. Concentrate can exist. Scrap can exist. But if refined silver can't move at speed, manufacturers don't get what they need. Then the real-world consequences start. Solar lines stop. Electronics slow. Medical devices face delays. Defense contractors start making calls nobody wants to receive. Here's the twist. When supply chains become political, price stops being the only tool. Countries start thinking like countries. They don't ask, what spot? They ask, do we have enough for ourselves? That's resource nationalism, domestic supply first. And if that mindset spreads, the global market stops behaving like one market. It fractures. Everyone hoards, everyone front runs, everyone grabs ounces before the next gate closes. So connect the dots. London goes quiet. Withdrawals are queued. Allocated holders become applicants. A $200 industrial bid is rejected. Refining channels tighten. That's not volatility. That's a chain reaction. A market can be open and still be broken. Price only matters if you can actually buy size and receive delivery. When quotes vanish and withdrawals get reviewed, the market isn't discovering price. It's rationing access. And in that game, the key number isn't spot. It's availability. How many ounces can leave a vault today? How fast can refiners turn feedstock into deliverable bars? How long before a manufacturer's safety stock hits zero? Those are the real clocks. And clocks don't care about opinions. They only care about time. In a few hours, New York opens. Algorithms will do what algorithms do. They'll trade paper. They'll trade the illusion of supply. They'll flash bids and asks that assume metal can be sourced because a spreadsheet says it exists. But If the physical pipeline is clamped, the paper price becomes a distraction at best and a weapon at worst. Here's the playbook to expect. First, turbulence, a sudden dump, a violent red candle, a fast flush lower designed to trigger stops, spark panic, and shake weak hands out of paper positions. Why? Because the easiest silver to source in a crisis is the silver you scare people into selling. ETFs, futures, paper exposure. If that selling happens, pressure eases. Not because metal appears, but because demand to convert paper into metal cools. If that fails, the second move is narrative, holiday liquidity, technical issues. Nothing is wrong. They'll point to gold trading normally and say everything is fine. But gold trading normally while silver flatlines isn't comfort. It's evidence. It's a flashing red warning that stress is concentrated in the metal with the thinnest inventories and the highest industrial dependency. Understand this clearly. The squeeze you're waiting for may not look like a vertical candle on your app. It may look like out of stock. It may look like premiums exploding while spot stays flat. Delivery times stretching from days to weeks. The spread between paper and physical becoming the real signal. Because in a true physical crunch, availability matters more than the official number. If you can't buy it, you can't price it. That's the nightmare. And it's also the giveaway. The cleanest signals aren't on the chart. They're in the excuses, delays, allocations. We can't guarantee delivery, substitution attempts, smaller bars requested because large bars are gone, quantity limits at dealers. That isn't marketing. That's rationing with a smile. So here are two questions you should be asking. First, if a $200 industrial bid can't find a seller, what happens when multiple industries bid at the same time? Second, if allocated metal can be delayed under compliance pretexts, what exactly do you own when you hold paper exposure? Now, I'm not here to tell you what to do with your money, but I am here to tell you what this pattern looks like. It looks like a system preparing for an event before the public is allowed to name it. Gatekeeping. Rationing without the word rationing. The calm before the only repricing that matters. Industry doesn't buy silver to invest. Industry buys silver to keep the lights on, to keep lines moving, to avoid penalties, layoffs, and contract failures. And when industry gets desperate, it doesn't negotiate. It bids aggressively and quietly. That's why the quietest markets are often the most dangerous. By the time the noise hits your feed, the best inventory is already spoken for. Here's what I'm watching next. When New York opens, watch the gap between physical premiums and paper prices. Watch whether out-of-stock banners stay up even if spot dips. Watch delivery times expand while commentators insist nothing happened. And most of all, watch London's silence. If this were a glitch, it would clear. If it were a holiday issue, it would resolve. But if this is a stand down, a containment, a vault clamp, the quiet continues until the system reopens on its own terms. That's when the real panic begins. Not with the first spike, but with the first refusal. The first no quote. The first we can't deliver. The first call back next week. That's how scarcity speaks. And here's the uncomfortable ending. If you're sitting in unallocated exposure, you're sitting inside the very system you expect to deliver in a crisis. And stressed systems don't reward claims, they reward custody. If you hold something you can touch, you don't need permission. If you hold something you can only request, you're asking for permission. At the exact moment, permission becomes expensive. That's why the London blackout matters. Not because of a candle, because of control. When demand gets serious, the gatekeepers show you what they do. They close the gate. If London stayed quiet today, it won't stay quiet tomorrow.